Okay, good morning, ladies and gentlemen. My name is Sam Cofer. I'm a real estate agent with Exit Right Realty, and today I'm here with my friend, Mr. Paul Lancaster, Assistant Vice President and also mortgage banker for Sandy Spring. How you doing today, Paul?
I'm doing well, Sam. How are you, bro?
Great, great, great. Look, man, before we get started, tell us a little bit about yourself. How'd you get into the mortgage business? How long have you been in the mortgage business? Tell us a little bit about yourself.
All right. Well, I started in kind of real estate in general at a real estate law firm in 2000. Stayed there until about 2005. Was a real estate paralegal. Did a lot of big transactional work, condo conversions and things like that. And as the firm was downsizing and they were letting people go, one of the partners said, "I think you'd be good at mortgages." And basically was like, "Why?" But okay,
Right.
I give it a shot. I mean, I had a real estate license, believe it or not.
Okay.
But I didn't really do many transactions. So I jumped into the mortgage world in 2005
Okay.
and was at a small brokerage shop and really kind of learned the business hands-on, grassroots, whatever you want to say, from 2005 to 2010. Market crashed, around that 2008 mark, 2008, 2009. I jumped out for a few years, got back in 2013, did a lot of online lending, so a whole lot of transactions at one time. Came back to what we call retail about 3 years ago or so, a little more, 3-4 years ago. So I've been in mortgages, I guess. I mean, it's how many years is that total? Wow.
Close to 20.
Yeah, a lot.
Yeah.
15 years, give or take.
Yeah. So that's good because you bring a lot of experience to the table when you're helping people who are trying to get approved for loans and everything, and you can kind of give them an idea and an understanding from various viewpoints, even from working with a smaller brokerage to working with Sandy Spring, as of today. So let me ask you this. We'll start with an easy question. What makes up an ability to be able to be approved for a loan? What are you looking for a buyer? A buyer comes to me, Sam, I want to purchase a home. Okay, I'll put you in touch with my guy, Paul. He's a mortgage banker. He'll be able to get you started. Well, what are you looking for as the banker, as the loan officer, as the lender, to be able to get that person pre-qualified or pre-approved?
So the kind of breaking it down to the basics, it's a six right now during COVID. Let me say, preface it by that. It's a 640, what we call middle score. Now everybody has 3 scores, so we just take the one that's the middle score, and it needs to be at least a 640. And that's like if it's you and a co-borrower, both scores have to be at least a 640 because Fannie Mae requires us to use whoever has the lowest. So if you got an 850 and your partner has a 640, the loan is based off of the 640.
Okay.
So, I mean, and then we're looking for, it doesn't matter whether you're self-employed or W-2 employee. I mean, we'll just get different documentation, but we're looking for mainly the credit scores, a 2-year history, what funds you may have towards a transaction, because no matter what, there's usually a gap in funds, no matter whether you're using down payment assistance, seller may be helping you with some closing costs. There's still some gap in funds there somewhere. So you still, no matter what your goal is, what you anticipate, you still need to have some funds in the transaction. I mean, and it's just good. You're buying a house.
Okay.
So whether maybe you've been saving and you don't happen to need all those funds, or maybe none of them. Well, you got a good savings to fall back on, or you own a house now, so no matter, things happen. Okay. So hopefully, so we're looking for savings, we're looking for credit, we're looking at your what we call your debt to your income to make sure those things fall in line. And generally, you're just looking for to make sure the bank and any lending institution wants to make sure that you will be able to repay the debt.
Sure, sure, sure. So you mentioned something about debt to income ratio, DTI, and I've had a lot of clients ask me, what is that? Okay, and we know that's a mix, that's part of the mix that helps you get approved, but what
Absolutely.
exactly is that? Can you elaborate a little bit more about that?
Yeah, absolutely, absolutely. So for us, and just taking a little deeper dive
Hmm.
into it, we have DTI is a front ratio and a back ratio.
Okay.
So what it is we're running your credit. So we're looking at not, you know, don't we're not harping on the balances per se,
Hmm.
at the payments.
Okay.
Uh, so your monthly payments, and then we're come up with whatever estimated payment there is for your mortgage. Like if you come to me and say I want a $300,000 mortgage, well I put that in. I'm looking at your credit scores, so I estimate a interest rate,
Sure.
and then I'm just going to put in some homeowners insurance. That what it might be a range. Of course, it's not 100%. I'm putting in property taxes. I'm
Okay.
putting in maybe mortgage insurance, depending on how much you say you're going to put down. I may put a HOA in there, depending on what you're thinking, or maybe a condo fee if you say you're
Sure.
going to have a condo. So that gives us a payment, whether
Okay.
it's estimated. So I'm taking your estimated payment, all of your monthly payments that show up on your credit report. So, car notes, revolving credit, installment loans, but just the payments.
Sure.
And we're lumping that all together to get,
Hmm.
a sum. And then whatever your gross monthly income is, we're
Hmm.
dividing the two. And
Okay.
that's how you get your back ratio. And that's the ratio usually, depending on what type of loan you're going to get, that would depend on how high that back ratio can be.
Okay.
So your front ratio would just consist of your gross monthly income versus your probable mortgage payment. So that's your front ratio. So
Okay.
obviously, the lower your front ratio, the better,
Right.
generically speaking. So what that entails is, you take those two, you get the front and the back. Obviously you don't want your front to be so high, and you don't want your back to be so high. So,
Right.
but like I said, it might depend on what type of loan you're doing. So FHA might allow your ratios to be a little bit more aggressive than a conventional loan.
Okay.
VA
Okay.
might allow your debt to income to be a little bit more aggressive at times.
Sure.
We always have to keep in mind the environment that we're in. We're in a COVID environment where lending has gotten a little more stringent.
Hmm.
Where it used to be, our requirements used to be a 580 middle score if it made
Right.
sense. Now it's a 640. But
Hmm.
during the beginning of COVID, a lot of lenders spiked to a 680. So
Okay.
they gradually come down to, I guess, what they would consider a happy medium, because you just never know what the future is going to entail with folks with their jobs and what's going on. So
Sure.
spending has gotten a little tighter, but
Okay.
we're
Okay.
busy. We're busy.
Yeah. 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 That and that's a good thing. That that we're still busy, considering everything that's going on. Let me ask you this: we've got a lot of millennials that are looking to purchase,
Hmm.
or thinking about it. They're thinking forward to purchasing their first home. But a lot of millennials have school loans. I
Okay.
mean, that's a
Yeah, absolutely.
significant part of their debts that they have to repay. How does a
Absolutely.
bank look at those school loans, and does that negatively affect the millennial, or even someone that might have been paying school loans for a significant period of time?
Yeah.
How does that affect their ability to get pre-approved?
Well, somewhat on the same concept. It depends on what type of loan you're going to do.
Okay.
So no matter whether your student loans are deferred and forbearance or what state they're in, they have to be dealt with, and we have to assess a payment even if you don't have a payment showing.
Okay.
And that's what a lot of people get tripped up on. Well, I'm in deferment or I'm in forbearance. Well, it doesn't matter to the lender.
Right.
Once upon a time, it did, but that was a long time ago. So there's no
Okay.
sense in bringing up. the glory is past. We're in the present.
Right,
You know?
right.
So, for example, if you're at a place where maybe you can do a conventional loan,
Mm-hmm.
there's a couple things you may be able to do. One, you may be able to put your loans into an income-based repayment. So,
Okay.
for example, you have $200,000 in student loans. I know that's
Sure.
a huge number. Well, maybe your income-based repayment is $200 a month,
Mm-hmm.
as opposed to if your 1% payment, which is kind of a standard, what we would use if we didn't see a payment, is $2,000 a month.
Okay.
So that would throw off anybody's debt to income.
Right.
So, or almost anybody. Let me not, I don't speak for the masses.
Yeah, well, yeah,
You
I
know,
understand.
making that money.
Yeah.
But for, I guess, garden variety folks, it would throw off their debt to income. So,
Sure.
So what we would need you to do, even in a COVID environment, was get your income-based repayment, find out what it is, and a lot of folks had it prior to COVID,
Mm-hmm.
and their student loans were just forced into forbearance without them even asking for it.
Right.
So we would want to know what that income-based repayment was, so we can use it as we're preliminarily calculating, and two, if everything sounded like it was a go and you liked what's being offered and you were ready to move, you would have to put those student loans back into repayment.
Okay.
Use that income base, because I need paperwork showing that.
Sure.
Flip side of that, let's suppose you are doing an FHA loan.
Mm-hmm.
Well, FHA does not care about income-based repayments.
Okay.
They only want to see a 1% payment. If there's no payment showing, they want to see 1%, or they want to see what we call a fully amortizing payment. So that income-based repayment won't do. So most garden variety, most FHA loans, we're just sticking in 1%.
Sure.
So sometimes it works, sometimes it doesn't, as far as your particular debt to income.
Okay. Good point. Let me ask you this. I had a client recently ask me, Sam, what is mortgage insurance? And I'm paying this amount for this mortgage insurance. Is there any point in which I can get it taken off? Do I absolutely need it for the life of my loan? I mean, speak on mortgage insurance for us.
So mortgage insurance is the lender's insured that, because in a lot of instances nowadays, you don't have to put down, most instances, people aren't putting down 20%.
Right.
So with the loans where you don't need as much down, like first-time home buyers, if you're doing a conventional loan, most of the time you can get away with putting 3% down, which is not a lot of what we call skin in the game.
Sure.
So when you're not putting 20% down, that amount is insured, and it ensures the lender that foreclose, we will be repaid.
Okay.
Or at least a portion of it.
Sure.
So
so it protects the lender, so to speak.
Yeah, and there's ways around it. You know, whether they're good ways around it or not would be up to the individual when we look at your individual situation.
Sure.
But broad stroke, the mortgage insurance on a conventional loan will go away a couple of different ways. Whether you make your just regular amortizing payments on a 30-year fixed,
sure.
It may go away in roughly give or take 8 years. Because when your loan to value, you're paying down your mortgage, reaches 78%, it will automatically fall off.
Oh, okay. Now, is that for an FHA loan, or is that for a conventional loan?
That's a conventional loan.
Okay.
And another way to do that is, obviously, if you purchase tomorrow at $300,000 and 2 years from now your next door neighbor who has the identical house sells for $450, well, you probably got 20% equity.
Yeah, 20% equity in the house.
You'll call your servicer, tell them, I think I got it. They'll tell you to get an appraisal, which you have to pay for. Then if you have it, you'll send it to them, and
Sure.
you can lose it quicker that way, as because the market is rising.
Right.
Now FHA is a whole different thing. FHA does require mortgage insurance, and it will stay for the life of the FHA loan.
Okay.
So previously, in years past, it only lasted for 5 years.
Okay.
But that's a long time ago.
Right.
So that ship has sailed. Wow, probably 15.
Sure.
Probably in 2010, probably 10 years or so ago.
Okay.
Somewhere around there. So the only way out of it for FHA folks is to refinance out of the loan.
Refinance out of it
into a conventional. Conventional product certificate, conventional VA, something else besides the FHA loan.
Okay. Now, you handle refinances too, right?
Absolutely.
Okay. Explain to me, are there different types of refinancing?
There's, what we call rate and term, where you're just refinancing for the rate.
Right.
And obviously, you may be in a 30-year and you want to go to a 15-year or a 20-year.
Sure.
To reduce the term. And then there's obviously, there's a cash out refinance.
Right.
Pulling some of the equity out for whatever, whether you're paying off debt, whether you're
renovating the house or something.
You may want to put your kid, that may be what you did as a savings to put your kids in college. And you pulling it out to pay the bill.
Right.
So, and obviously there's, FHA has streamlined refinances where if you are in an FHA loan and maybe you did a down payment assistance program and the rates are higher for the initial part, you have to make 6 on-time payments, and you could do what's called a streamlined refinance, where maybe the rates they're offering are upper threes and the market is bearing middle twos.
Yeah.
After you do those 6 payments and the market is still good and your credit score allows it, you can streamline refinance to a better rate.
Okay.
And VA has the same thing.
Sure.
Called an interest rate reduction.
Okay. Cool. Explain to me how how the refinance process works.
It's very similar to. You take the mortgage application,
Mm-hmm.
And the questions are a little bit different. I may ask, what do you think your home's value is? Because
Sure.
I don't really know. I'm probably looking at the same thing as a consumer, maybe Zillow or something like that. So I kind of figure they may have spoken with a realtor or may know the lay of the land.
Sure.
In their neighborhood. So, the documentation is a lot less for that, because I may need, pay stubs, W-2s the same.
Right.
Lots of folks will roll whatever fees there are into the loan.
Mm-hmm.
You do that on a refinance where you can't on a purchase. So they, documentation, it's a lot less.
Sure.
The process at this point in time, it's a extended process. So most of the time you can do a loan in 30 days. Refinancers are probably taking a couple of months right now, just because it's so busy. And purchases take preference only because they have contract dates.
Right.
Stuff that we have to meet. So, but it's really a great time to refinance. I was just doing one before you called me.
Yeah.
A lot of folks are able to refinance and with conventional and FHA loans, and they're getting rates in the 2s, depending on score and loan to value.
Sure. Okay. Cool. So, Paul, I'm not gonna hold you too long, but how can people reach you?
They can reach me. The easiest way is on my cell phone. That number is 240-464-3296. 240-464-3296. You can also email me at Lancaster. That's Caster at sandyspringbank.com.
Great, great. And you're on social media too, right?
Yeah, I am. I'm on Instagram as Paul the Mortgage Man, and I'm on what's the other one? Facebook.
Yeah.
PD Lancaster.
Nice, nice, nice. One more question before we get you out of here, Paul. What are you seeing in today's market? Obviously, we've been in COVID for some time now. Are you still seeing the market strong, or are you seeing it wane? Like, give me an idea of what you're seeing as a mortgage lender, because I know for me, I'm seeing that the market is still strong. This is a great opportunity for sellers to sell and buyers to buy. You tell me what you're seeing on your side of the tracks.
Exactly the same. It's probably, I was extremely busy. You know, summer times, the spring, summer are our months, are the best months in just the real estate world.
Right.
And last spring, summer, I thought I was insanely busy, but this one I'm even more. You know, the rates are wonderful. I'm not sure if I've ever seen them quite this low, and everybody says, oh, they're historically low, they're historically low. And I've seen them higher. I've seen them much higher.
Sure.
I thought they were low. And I've seen them low, and I don't think I've ever seen them quite this low. So I mean, it's a great time to buy. Everyone's insanely busy, so just, you know, be patient. And when you do decide that, I'd like to step out with Sam and get this done, and he sends you to me, you know, or anybody, if you had somebody else in mind, just be patient, because everyone's insanely busy. And, and, you know, be decisive though. Do your applications. When they ask for docs, I think especially in this market, the biggest assistance you can do for yourself and them is to try not to piecemeal the docs. I mean, everything at one time. Try to do one email, you know, and I know it might be a little harder because it's COVID and you may not have as much access to things, but as much as you can, try to even make it into one document if you can. Everything that they wanted, and just read the emails. And you know, because a lot of times I think a lot about down payment assistance, so I may ask for 3 years of tax returns because that's what Maryland or programs may want. And they ask for that just generically. And I always ask people to sign and date the tax returns. Well, if you decide to use a Maryland mortgage program and you haven't signed and dated them, then that's just another step. I got to send it back to you. Sign and date. So just, you know, just pay it. Generically pay attention to what's being sent to you, and be decisive as you can. Be quick, you know, as quick as you can, because, you know, I have a lot of folks who apply and give me the documents that same day or within a day or two, and then some folks apply and then all of a sudden 3.5 weeks later, you know, documents.
You get some docs or something,
I mean, which is fine too. I mean, you know, I don't know you never know what's going on in people's household.
That's true.
Or things like that. So you get them when you can, but just be as quick and decisive as you can and be as complete as you can, especially in a market like this, because things are, you know, I don't have to tell you, you're out there in the streets, things are probably moving so fast. You know, off the shelf, shall we say. Like if you like it, you have to be decisive. Because if you're not, you know, while you're thinking, someone's writing.
That's right. It's here today, gone tomorrow, man.
While you're thinking about it, you know, they got 5 offers.
Exactly.
That's what I'm seeing.
Yep. All right, Paul. Well, I appreciate everything, man. Appreciate your time. I know you're a busy man, but I appreciate you carving out this time for me. And we're definitely going to be getting some people, you know, to you. We already started, and we appreciate everything you've been doing for us. So, you know, we'll definitely be in touch, man. And, you know, hopefully we'll get some more business going soon.
Absolutely, man. We will. Thank you. Thank you for
no problem. Thank you, Paul. I really appreciate it, man.
All right. Have a good day, bro.
All right. You too.